Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview. And I'm delighted today to be joined by Dr. Amrita Sen, co-founder and director of research at Energy Aspects. Great to have you with us, Amrita. Thanks for joining us.
Thank you. Thanks for having me back.
Well, we are at the start of the second quarter, so let's get right into it. Let's talk a little bit about demand. I'd like to talk about demand before we hit some other points on the energy scene. China was very much being seen as the factor, and perhaps still is, to pull the demand back, I suppose, into the market. Good Q1 results on economic growth then, and yet oil prices still a bit volatile. OPEC had to step in to support prices. Where's that $100 that you, perhaps, and others were thinking we might get at this point?
Oh, the $100 call is for the second half of the year. It's not for the first half of the year, for the simple reason that we've built a lot of inventory in Q4 and early parts of Q1. That shouldn't be confused with China's recovery. China's recovery is phenomenal right now. The March data that came in for demand, it came in about 600,000 higher than what we had expected, and we had already expected a pretty decent uptick. So outright demand was over 16 million barrels per day. So I don't think, and I understand on a simplistic basis, people are going to be like, oh, this means China isn't growing. China isn't the problem over here. The problem is the West, of course, has slowed down, which is again in our expectations. But the real reason why oil prices are struggling is much more to do with financial flows rather than fundamentals. If you look at physical grades around the world, be it in the Middle East, be it in the North Sea, which is, let's say, it's dated Brent, they are much, much higher than the paper prices are, in part because it's just been a very volatile, like you say, a volatile scene, which keeps traders away. And I think that's one of the big issues right now with the market, that they want to see bigger stock draws. We've actually been seeing stock draws since March, counter-seasonal. They want to see that tightening happening first before they come back in. So I think prices will be going up. It's not going to be in Q2. There's just too many macro headwinds. It's going to be from the second half of the year.
Okay, I mean, so yeah, second half has always been, as you said, looked at as when we're really going to see, a more of a recovery from China, etc. But you mentioned what is obviously a dampener on that, which is the fact that the Western economies are still under stress and question in terms of, is this recession coming? Is it not? In the US in particular, some people in the last month or so that we've talked to have said this year of two halves, actually, we don't believe in it anymore, and we're not going to see that 2 million barrel a day growth for oil that people were sort of forecasting on the whole for the year. You seem to disagree with that, but isn't the whole, as you said, the hesitancy on the financial side going to continue to dampen the mood, if you like, even in the second half of the year?
So I think there's two things, right? One, I've never, and one of the things we've always highlighted is that we've never actually bought into this 2 million barrels per day demand number. We are the lowest on the street. We have 1.5 million barrels per day of year-on-year growth because we think US demand is going to outright decline. European demand is going to outright decline. So I think the market is wrong. The market is wrong in predicting such a big demand increase, especially given we are in an industrial recession. We may not be in an overall technical recession, but we definitely are in an industrial recession in Europe, at least in the US, and to be honest, parts of Europe as well. So expecting 2 million barrels per day of growth would require some miracles out of Asia, right? That's not going to happen. So that's one thing. So on our forecast, we are very confident that we still get the tightness in the second half of the year because we have actually already factored in a recession in the West. When it comes to the macro environment, I think the headwinds will persist, yes, but I think right now the fear is we could get a hard landing. Our forecasts are calling for a soft landing. We are saying, yes, we are forecasting, and we've always forecast for this year, a mild recession in the US, a mild recession in Europe. I think if the market gets clarity that yes, it is going to be a mild recession, that the banking system, while fragile, isn't going to fall over, then it is a very different picture. It allows risk assets to perform. So I'm not saying that the headwinds won't persist, but I think the oil market has probably priced in a bit more towards the hard landing rather than let's get some evidence. And if it is more towards the softer landing, then prices can still rally.
Okay, so they're being more conservative. Well, you mentioned that the 1.5 rather than 2 million demand growth, and of course OPEC earlier this month came in and declared they're going. Some of them declared they're going to cut more than obviously what's already planned. Do you expect? First of all, do you think that they called it right? I mean, do you think they were right to do that? Was it timely? And are we going to see that 1.6 million barrel they start to be cut on May the 1st? Do you think, realistically speaking?
So I think the decision was absolutely right in the sense that you needed some form of stability, right? And that's what OPEC Plus were trying to provide at that time, with all the banking crisis in the background, saying, okay, look, at least for oil markets, timing can never be perfect for anything, right? Should they have done it earlier or later? No, but I mean, that's just to do with broader macro concerns. But what they did is exactly correct in the sense that saying, for investment purposes, for long-term investment, there needs to be stability in the market, and that's what OPEC provided. So I think that, to me, is super important in kind of, again, getting the market's confidence. But I also think the question you asked as a follow-up is one of the big reasons why we haven't seen traders come and put positions, because there's still a lot of skepticism whether these cuts will actually materialize. In part, I think a lot of US officials have been going around and saying, oh, we actually don't think the cuts will happen because this was a surprise cut to them as well, and they have every incentive to keep oil prices down. We're not expecting 100% compliance. There's always a few countries that slip, but on average, historically, if you look at voluntary cuts, the compliance is anywhere between 96 to 98%. So these are some high numbers. We are absolutely expecting Saudi Arabia to lead in the efforts of cutting production. Russia, we are seeing similar numbers already being cut because their cuts came in earlier. Between crude and products like exports, you can kind of tally it up to be 500,000. So again, going back to if the physical crude market was weaker, I would get a lot more concerned about the health of the market. But given how the physical is trading, this is much more about the confidence coming back. And the confidence is twofold, like we discussed on the macro side. And the second thing is absolutely around OPEC. People want to see these OPEC cuts first. So like May being the first month of these cuts, even though we're trading June. But again, I think the numbers need to reflect that. Then we can get a rally.
Okay, and I mean, again, I suppose, and also that's going to depend on central bank policy going forward. As you said, what's going to happen in May, June. If there's more tightening than expected currently, or factored into prices, then obviously we could see OPEC come in again, and support if things drop below $80, presumably. Let's talk a bit about the physical market and talk about Russian oil, because again, contrary to, I'd say, the majority of expectations of last year, we have not seen a disruption to Russian flows. We've seen redirection. Perhaps that was the intention, but we certainly haven't seen anything near the 3 million that was being called last year. Do you expect that situation to continue this year, i.e. no other changes in Russian oil flows as the year goes on for products and crude?
Yeah, I think that's absolutely spot on. Look, even we were initially expecting 2 million barrels per day of cuts. In fact, when the invasion had initially happened, our take was, look, we will actually not get a disruption. It's going to be a redirection. Then the sanctions ratcheted up. And I think we, like many others, actually fell for the fact that, oh, these are some real sanctions and that's going to hurt Russia. Little did we know, and I think now it's very clear, that the sanctions were never actually designed to hurt Russia. That's the reality of it, right? These sanctions are meant to keep the oil flowing. There's a lot of talk among the Western politicians about, how much this is hurting Russia, but the reality is that the oil continues to flow. The revenues are still going back to Russia. Sure, Urals is trading at a discount, but the middlemen who are actually trading these barrels, they definitely have connections in Russia, which means at least some of the money is going back, right? So again, these are pretty toothless sanctions in that sense. Then that's why one of the big reasons that oil has continued to flow. So right now, and our forecasts are the same for this year, we are only expecting about 500,000 barrels per day of year-on-year decline. Their latest forecast that came out yesterday confirmed that as well. And between the crude and product exports, that's roughly what you are seeing. And I think one of the things I will highlight is that a lot of people just look at the crude exports from the main ports, and that hasn't necessarily come off. But there's a lot of oil that also flows on pipeline in Russia, Druzhba into Europe, but also non-Transneft systems. We collect all of that data, and you can actually see that the flows on those systems are falling. And I think that's how we'll get that 500,000 barrels per day cut.
Okay, and what do you think about, just to think about the current news this week of the US pushing for this extra sort of trade embargo of goods into Russia, which the EU and the other G7 nations seem to be opposing? Why do you think the US is pushing for that? I mean, do you think it believes that will cripple Russia in its war effort? Or is it just playing a bit of geopolitics? Where do you see that pressure?
No, I mean, look, there's been continuous talks of doing more and more over the last year, right? So it's not that it's come out of nowhere, but again, it's just another effort to try and hurt Russian revenues. I think that's been very consistent, that the effort's been there. I just don't think in practice they've designed stuff to make it work. And of course, Europe is going to be against it because the retaliation that Russia does is going to hurt Europe a lot more, right? But yeah, I think these are just broader efforts to cripple Russian revenues. That's where the price cap had come in as well. And I think the US administration still takes a lot of pride in assuming that the Russian revenue losses because of the price cap. The reality is Russian oil was already trading at those kind of levels because of the increase in freight costs, right? You're now moving oil rather than from Russia to Europe on a pipeline, you're putting it on a ship that needs to go 30 to 50 days to Asia, right? Of course, freight's going to go up, and therefore the price of Russian oil needs to go down to accommodate that, right? And I think that's exactly what you're seeing in the market. And the price cap has obviously kept some of the flows going, which in European vessels, but I don't even think that would have made that big a difference, because one of the big reasons why Russia has managed to continue with its flows is because it's just managed to get hold of so much shipping, converted like the legal fleet to the dark fleet more than anybody expected. I think that's what's happening. So I think, again, the US measures are just another effort in seeing if they can, hurt Russian revenues.
Okay, well, let's talk just a bit about gas. And you mentioned the US as well. And I wanted to talk about the US's sort of approach to this from also, let's talk about its shale industry as well on the oil front. But last year, when there was gas prices spiked a bit ahead of winter, and Europe was kind of reorganizing itself and admittedly did a good job and got through the winter because of the weather. But we saw quite a bit of US LNG also coming to Europe. What's the outlook for that this summer into winter, in the sense that will the US possibly need that LNG itself? What about competition for Europe with Asia on terms of gas supplies? Are we putting this gas sort of crisis for 23 to bed? Is everything in better order this year for Europe?
So I think, again, like you said, we got lucky with the weather, right? That's definitely helped. But reservoir levels are quite low right now across Europe. So drought conditions are being warned off in many, many places. So let's see what the summer holds. We believe this year gas prices will be low across Europe and in the US, because US was extremely mild as well. So there is a lot of gas to give. Asia, of course, with China's reopening, you are going to see some more demand there. But it's really next year and the year after we think the curve, or TTF in particular, is still too low. The crisis hasn't gone away, right? And Russian flows will be low year on year as well this year. So I think, generally speaking, if gas prices get too low, industries which had switched away from gas will come back pretty quickly. And that's a chunky amount of demand that can come back. So I would be very careful, and this is much more for the politicians in Europe, to become complacent about this. I think there was absolutely a lot of demand destruction by choice, I guess, in Europe, which allowed inventories to rebuild. But then we got extremely lucky with the weather, right? that may not happen again with the weather, right? So again, if inventories are at decent levels going into next winter, not at record highs, but decent levels, I genuinely believe the market will be very complacent, saying, okay, we got through last year, which was going to be worse. But I do think where prices are right now, you can start getting a lot more of that demand back, which can, which can really be a shock to the market again, more for next year, like I said, like more like a winter 2024, so like early 24 story rather than this year, but definitely would warn against the complacency.
Could we get a shock to the oil markets, do you think? I mean, given that, obviously OPEC's doing what it's doing, it's cutting. Is the flexibility there to prevent a shock happening if we get this demand coming back, as you are saying, in the second half more clearly?
So for me, the second half tightness is actually more supply driven rather than demand driven. So I'm not saying that we are expecting additional demand. It's more that our forecasts are already factoring in a slowdown in the West and China continuing to reopen. But the big OPEC cuts are second half of the year, right? Because they're only kicking in May. So in some ways, I think the issue is that, yeah, look, if the market over tightens, OPEC can bring this back. It's not going to be an issue for at least some of these countries. And you do have some spare capacity now with the kind of cuts that you've seen. But I think what is interesting is that ultimately, and remember last year we had the same kind of debates around, once, let's say, OPEC has brought these voluntary cuts back, then what, right? There isn't a lot of spare capacity in the system. So again, I don't think it's necessarily a concern right now with the demand scenario, but let's fast forward maybe a year or two, then yes, it does become a real issue if, say, quote unquote, the global economy is normalized, right? Like we're through the kind of mild recession, Asia's opened up fully, China's booming, then I do think spare capacity is extremely constrained. And we just haven't seen the investment, and shale isn't growing nearly as much as what it used to grow.
Yeah, with a lot of it, and shareholders there just focusing on returns, right, and dividends more than anything else, and the companies seem to be honoring that. Let's talk a little bit about China and India taking the discounted Russian crude. I mean, obviously that saved Russia in a way, hasn't it? Because they've continued to take that Russian crude, but no one else would. Are there any long-term sort of risk factors there for those consumers? In terms of how it might antagonize their traditional suppliers, for example, those in the Gulf here. And secondly, Amrita, what's your viewpoint on this sort of whole talk now these days of the de-dollarization of oil and commodities in general going forward, with countries like Russia and China taking their unilateral stance on how they pick and choose what they take and when?
So let me put the first question in context. This gets asked a lot, right? Oh, India and China taking more Russian oil. Does this mean that the Middle East is going to be upset about it? They haven't stopped taking Middle Eastern oil, right? Demand is growing in both countries, so they can take both. What they have backed out is more West African. So it's Atlantic Basin oil that they have backed out, be it West Africa, some Latin America, some US. And I think that's the interesting thing, that India, China both absolutely realize the importance of the strategic relationship with the Gulf countries. They are not going to change that, right? So this hasn't been, we've taken more Russia at the expense of the Gulf. It's been taking more Russia at the expense of Atlantic Basin crudes. Right? That's the first thing. Second question on de-dollarization, I smile because this has been going on for such a long time, right? This debate. Look, there's a difference between transaction cost, the transaction currency versus settlement currency. You can transact in any currency that you want, but if the settlement of that product is in dollars, it's like Brent prices over 70% of the world's oil, right? Doesn't matter if it's a West African oil, it's a differential to Brent. Effectively, it's the same concept. The settlement price is still in dollars, right? China launched a yuan contract. It didn't really go anywhere, right? Like they still have that. And I think the difference is I really do believe there's going to be more and more transactions in non-dollar denominated currencies, and especially with the world kind of becoming a world of two halves, so as to speak, right? Russia, China, India, Middle East getting closer versus the West. But ultimately, the price is still in dollars. You can transact in any other currencies, but you'd have to convert it back. And I just don't think that's changing anytime soon. I think, of course, over the next few decades, there will be more and more pressure to de-dollarize, yes, but we are nowhere close to, because again, the settlements of no commodities really, no major commodities are still being talked about in other currencies.
Amrita, do you subscribe to the point of view that we're going to, we're seeing sort of oil markets and equity markets can start to sort of diverge in their track, if you like. If the Fed continues on its inflation reduction track as it is expected to do, but let's say it's more hawkish than people are pricing in today, that will surely have a negative influence on equities again, as we saw last year. Will that also then drag oil down with it to an extent, or could the two be completely separate?
So I think it entirely depends on which time of the year you're talking about. I think if that happens in Q2, like our colleagues at Medley Advisors who do the macro analysis expect another 25 basis point increase in Fed rates, right, at the next meeting. I think that's consensus, but again, you never know, right, how the market's actually priced in. But I think one of the issues and what's interesting in all of this is that if this happens in Q2, I think that is going to be a headwind for oil, because the macro is still very uncertain and people just don't know how it's going to pan out, because we're still talking about a hard landing. However, if this happens deeper into Q3, when the oil market in itself, the fundamentals are super tight, the market is just like there's a lack of crude in the market, that's very different. I think then, yes, oil can decouple.
Okay, and what would you say would be your sort of average for Brent for the end of, for the year end, essentially, for the average for the year by the time we get to December? Where would you put the range there? I mean, OPEC is coming in and defending anything below $80. We know that. Is that enough to say that, yes, we will not dip below 80 again this year?
No, I do
How
think.
high could we go?
No, we can dip below 80, right? I don't think that's a given at all. And I also think we should be careful. Like OPEC aren't defending a certain price. I think what OPEC are doing is they absolutely do not want a buildup of short positions. If that happens, they can, they will step in again, but it's not necessarily about a specific price level. I think 80 to 120 is the range you're looking at.
Okay, which is pretty wide.
Yeah, it's a wide range, absolutely. But again, it could be caused by, you've got so many unplanned outages right now. Imagine this happening in the second half of the year. Again, right now we can absorb a lot of this because we have inventories. Second half of the year will be a lot harder.
And I mean, a lot harder, not just on countries like China, who are buying discounted oil, luckily, but China is okay. But what about the impact of anything above 85, 90 on these developing economies that are in huge debt, obviously having to pay back their debt as well, which is in dollars? What's any fallout to come from that, if you like, that would ripple back across to China and to Europe?
So China, for instance, I would say that you've already seen the Western slowdown being an issue because manufacturing in China is the last thing to recover, right? It still hasn't recovered because the goods buying is just weak in the rest of the world. So China's recovery is very consumer-led, and I think that's exactly what I was alluding to. Like it's a very strong recovery because again they've been locked up and they're kind of coming back, but the manufacturing hasn't fully recovered, and I don't think it will because. Or it will be the last thing to recover, and it will probably be the thing that recovers at the end of the year into next year, right? But your question around what happens to a lot of these kind of smaller countries, I think it's very valid. Again, one of the reasons why we're not particularly bullish about, let's say, Southeast Asian demand growth, a strong dollar really hurts them as well, right? And I think, I mean, you've seen this in Sri Lanka, you've seen it in Pakistan. I think those countries are different in that sense, that they're too small to have an impact. Again, these are the fears that are keeping the market from going in full, like all in, right? Because you just don't know, Pakistan and Sri Lanka might be two small countries to have a ripple effect, but what if it's another relatively big Southeast Asian country, right? And that then can have an impact where it has a ripple effect and it can again drag the whole region down. That's not our base case. Yes, we do think demand growth will slow from a stronger dollar, impacting their economies. And also, I think generally people have saved up a fair amount over COVID. So the consumers are actually a lot stronger right now than they've ever been in the past 2 decades. So I think that's the positive. But of course, it's a tail risk, especially if the Fed overdoes it on the tightening.
Okay, and one more question for you, Amrita, before we go. Just again, to flip back to supply, we talked about OPEC supply and US supply. What about a few of the other countries or regions where, again, you see Brazil, Guyana, etc., where even Iran supply is coming back on track, and maybe we're going to see some détente there in this region. I mean, how much of that may we see come to fruition this year, if you like, and impacting prices in any way? Or again, is that not accounted for?
Do you mean not accounted for in the current price?
Predictive prices, yeah, exactly. What's being predicted in terms of the ranges that you talked about?
There's the supply disruptions. I mean, look, I'd say right now it's not, right? Because I think like what you're seeing in Iraq, for instance, Turkey, rather, most people think the pipeline's already back. So I think it's one of those things where the market has been really complacent about just how, or rather, I wouldn't say complacent. I think it's been too focused on demand and therefore not taken into account any of the supply outages. Again, it doesn't matter right now because we've built so much inventory that needs to be run down. Yeah. This is why my fear is for the second half of the year, come June, because we were expecting draws to really kick in from June. The draws started earlier from March. We are seeing counter-seasonal draws. And because it's counter-seasonal, come June, suddenly we'll be like, oh, hang on, we are going into peak demand period without a buffer. So I think the next 2 months will probably be pretty range-bound / boring, but it does set us up for a very, very strong H2. Barring, of course, a massive recession. It's good. If it's a mild recession, that's fine. But if it's a bigger recession, it will be much harder.
Well, no shortage of gray or black swans out there to knock us off our perch. But Amrita Sen, co-founder and director of research at Energy Aspects, thanks so much for your time today on Halftime Talk.
Thank you so much for having me. It's a pleasure.